This retirement planning mistake may cost investors with portfolios like yours millions of dollars, and people don't even realize they're making it. Hi, I'm Mark Fonville, CEO of Covenant Wealth Advisors and a certified financial planner professional. Today, I'm going to show you exactly how market timing doesn't just underperform, it systematically destroys wealth by turning temporary market declines into permanent, unrecoverable losses that can cost hundreds of thousands to millions of dollars depending upon your personal situation. So if you want more insights like this on protecting and growing your wealth during the critical years before and after retirement, go ahead and make sure you're subscribed so you don't miss future videos. So let me start with a question. When the market drops, let's say it falls 10 or 15%, what's your first instinct? For most people, it's just to get out. Protect what you have, wait for things to calm down, then get back in it when it feels safer. Now, think about what that actually means. When you're watching your portfolio drop 10, 15, even 20%, your instinct to get out feels completely logical. It makes perfect sense emotionally, but here's what most people miss. This very logical, protective instinct is costing pre-retirees and retirees like yourself more money than almost any other financial decision they make, except possibly poor tax planning. But that's a whole nother topic. Now, according to Morningstar's 2025 Mind the Gap study, analyzing more than 25,000 funds representing approximately $24.5 trillion in assets, the average investor earned 7% per year over the decade ended December 31st, 2024, while the investments themselves earned 8.2% per year. That's a 1.2% annual gap. And it's not because of fees. It's because of timing, buying and selling at exactly the wrong times. Now, 1.2% might not sound like much, but here's where it gets painful. Let me show you a hypothetical example to illustrate the long-term impact. If we assume the 8.2% annual return that funds earned over the past decade and compare that to the 7% return that the average investor actually earned, here's what happens over time. Over 20 years on a $1 million portfolio, that 1.2% behavior gap could leave you with approximately 21% less wealth. Over 30 years, about 28% less. Now, let me make that concrete with a specific example. Imagine you have a $1.5 million portfolio today. If your investments earned the same 8.2% annual return that funds averaged over the past decade, you'd have approximately $10.8 million after 25 years. But if you fall into this same behavior pattern, earning only 7% annually due to mistimed buys and sells, you'd end up with approximately $8.1 million instead. That's approximately $2.7 million less, or 25% reduction in wealth than if you had simply stayed invested. Now, this is a hypothetical example for illustrative purposes and does not include taxes or fees. And of course, your actual results will vary based on your specific investments and time horizon and market conditions, but the principle remains. Even seemingly small gaps compound dramatically over time. So that's not a market crash destroying your wealth. That's your decisions destroying your wealth. But here's what's really important to understand. This isn't about willpower or being smarter about timing. The research shows that even professional money managers struggle with this. The problem isn't that people are making dumb decisions, it's that market timing itself is fundamentally stacked against you. So let me show you why. Here's what makes market timing so dangerous. The best days in the market don't arrive when things feel comfortable. They arrive when things feel terrible. This chart from our research partners shows what happens when you miss just the best days in the market over the past 25 years. If you invested $1,000 and stayed fully invested through all the ups and downs, you'd have $6,973. That's nearly a 7 times return. But watch what happens if you miss just the 10 best days out of those 25 years. Your $1,000 grows to only $3,105. you've just cut your wealth by more than half by missing just 10 days out of roughly 6,300 trading days. But here's the part that makes timing quite impossible. Those best days almost always cluster right next to the worst days. Research from JP Morgan's private bank found that 7 of the 10 best market days occurred within just 15 of the 10 worst days. Wells Fargo documented the same pattern in March of 2020. Several of the best and worst days happened within the same week. Think about what this means practically. When do you feel most compelled to get out of the market? When it's scary, when volatility spikes, when everyone's panicking. But that's exactly when those explosive recovery days tend to happen. The days that drive your long-term returns. And this pattern isn't new. Look at this chart showing nearly 50 years of stock market returns. The dots represent the largest intra-year decline each year, and the average, a drop of 13.5%. But notice what happens most years. Despite that average 13.5% decline during the year, the market still ends positive. Not every year, but most years, averaging 9% gains annually. Now, volatility is normal, pullbacks are normal, and investors who stay disciplined through that short-term volatility have historically been rewarded. But here's what happens when you try to time your way around it. Let's say, for example, you sell after a scary 2% down day, thinking you'll protect yourself and wait for a better entry point. This chart shows the effect of exiting the market for different durations of time immediately after a negative 2% market day. Deciding when to re-enter is difficult and often results in worse performance than simply staying invested in the first place. For example, what happens if you stay out of the market for a week after each 2% decline? Your $1,000 would have grown to only $3,839 over 25 years instead of $6,973. Stay out for 1 month after each 2% decline, you ended up with only $3,059. Stay out for a full year every time there's a 2% day. You end up with just $1,701, barely more than you started with. Here's why this matters so much. Once you sell, you now have 2 decisions to get right: when to get out and when to get back in. And the research shows that most investors get both decisions wrong. They sell after the damage is done, missing the early stages of the decline, but locking in the losses. Then they wait until they feel safe to get back in, which usually means they've already missed the recovery in the first place. Now, here's another example. In this chart, you'll see an illustration of another common trap. Many investors sit in cash waiting for a bigger pullback before they invest. But look what happens. If you're waiting for a 5% pullback, the average wait time is approximately 303 days, and the average return missed is 13.8% while you're sitting there. The perfect opportunity you're waiting for might never come. Or when it does, you might be too scared to act on it in the first place because the headlines are even more frightening than before. Just one quick reminder, if you're finding this valuable, please go ahead and hit the like button. It helps more people discover this information, and be sure to stick around until the end because I'm sharing our free retirement readiness checklist, which includes 15 comprehensive checklists and workflows covering hundreds of critical items that you need to address prior to and during retirement, including key issues to consider with your own portfolio to weather market volatility without panic selling. Now, everything I've shown you applies to accumulators, people still building wealth. But if you're within 10 years of retirement or already retired, the damage from market timing can be quite catastrophic. And here's why. It's what's called sequence of returns risk. During your working years, if you sell low and buy back high, you've made a mistake. But you have time and ongoing contributions to potentially recover. But in retirement, you just don't have that luxury. You're withdrawing money while the market does its thing. And the returns you get in the first 10 years of retirement have an outsized impact on whether your money lasts 20 years or 35 years. Research by financial planning experts Michael Kitces and Wade Pfau shows that early returns explain the vast majority of sustainable withdrawal variability. So what does this mean practically? If you sell during a market decline in your first few years of retirement, trying to quote unquote protect yourself and then miss the recovery, you potentially permanently lowered the amount you can safely withdraw for the rest of your life. So if market timing doesn't work and actually destroys wealth, what should you do? The answer is simpler than you might think, though it requires discipline and a plan. First, have a strategic allocation or portfolio mix that matches your actual spending needs, risk capacity, and tax situation. This isn't about being aggressive or conservative. It's about being appropriate. And once you set that allocation, you stick with it through market cycles. Second, use rules-based rebalancing instead of emotional timing. When stocks run up and your allocation drifts too heavily towards stocks, you systematically rebalance back to your target, selling higher. When stocks get beaten down and you're below your target stock allocation, you rebalance by buying or buying lower. This captures what we call reversion to the mean without trying to predict what the stock market will do next. Third, and this is critical for retirees, maintain a liquidity sleeve. Keep 1 to 3 years of planned withdrawals in cash or short-term bond investments. This way, if the market drops 20% in your first year of retirement, you're not forced to sell equities at the bottom. You can draw from your liquidity reserves while your equities recover. This approach mitigates sequence risk without requiring you to time the market. You're comfortable staying invested in stocks with the rest of your portfolio because you know you're not going to need that money for several years. And fourth, automate as much as possible. Whether it's systematic contributions during accumulation or systematic withdrawals with guardrails in retirement, automation removes the temptation to make the next call. While there are a lot more complex strategies that we implement here at Covenant Wealth Advisors, these steps are a really great start. So look, I understand why market timing is tempting. When you see your account balance drop by 6 figures in a month, every instinct tells you to do something. But the evidence is overwhelming. Staying disciplined, staying diversified, and staying invested with the right liquidity buffer in rebalancing guardrails gives you the highest probability of achieving the compounding returns your retirement plan needs. The investors who build lasting wealth aren't the ones who successfully time the market, at least in our experience. They're the ones who successfully ignore the urge to time the market. So let me go ahead and recap key points. Market timing creates a behavior gap that costs the average investor about 1.2% per year, which compounds hundreds of thousands of dollars over a typical retirement timeframe. You can't avoid missing the best days if you're trying to avoid the worst ones, because they cluster during the most volatile periods. And for retirees, specifically mistiming in your early retirement years can permanently damage your withdrawal sustainability. The alternative isn't complicated. Maintain a strategic allocation matched to your needs, rebalance systematically rather than emotionally, keep adequate liquidity so you're never forced to sell at the worst time, and stay invested throughout the noise. Now you have a framework to protect your wealth from the most expensive mistake in retirement planning that we see in practice. So, are you ready to apply this to your specific situation? We're offering a complimentary retirement assessment specifically for investors with over $1 million in retirement savings, excluding real estate, where we'll review your current strategy, identify potential gaps, and create a personalized roadmap for your retirement. There's no obligation, just actionable insights tailored to your goals. Go ahead, click the link in the description down below. You can visit us at covenantwealthadvisors.com to schedule your assessment. Also, we've created 15 free retirement readiness checklists that walk you through hundreds of critical items you need to address before retiring, including portfolio structuring, tax optimization, income planning, and a lot more. Go ahead and download them using the link in the description again down below. And this is just our gift to you just to help you retire with confidence. So if you found this helpful, please go ahead and like this video and share it with someone who's planning for retirement. And if you have any questions about market timing, withdrawal strategies, or anything we've covered today, go ahead and drop them in the comments below. Finally, if you're not already subscribed, hit that subscribe button and turn on notifications. We publish new retirement planning insights every week to help you make smarter financial decisions during the most critical years of your financial life. We'll see you next week. Thanks so much.